All right, let's jump straight into this extremely important breakdown because as we move through 2026, the Social Security Administration is enforcing dramatically different rules depending entirely on the exact year a person was born. Welcome, everybody. I'm honestly thrilled to guide you through this today because the material we're covering here is, and I truly mean this, incredibly important for your long-term financial future. So many people still assume Social Security works like one giant universal program. They think, well, if my cousin or my coworker retired at a certain age and received a particular amount, then I'll automatically receive the same treatment too, right? Actually, no, that assumption is completely wrong. Your full retirement age can be entirely different. Your available claiming strategies can be entirely different. And most importantly, the errors, the small choices that permanently shrink your monthly payment, can vary dramatically depending on your birth year. So today we're going to carefully examine these rules so you can understand them clearly and avoid the costly mistakes hidden inside the system. Now here's the unfortunate truth. People in every age bracket are losing money. They are making permanent claiming mistakes simply because nobody ever clearly explained the exact rules tied to their personal situation. Social Security regulations shift constantly. It's like trying to solve a puzzle while the pieces keep moving around. Retirement ages change, earnings limits get adjusted, Medicare premiums increase, and overpayment enforcement policies seem to change overnight. And here's the biggest issue. Whenever these updates happen, the SSA doesn't mail out personalized letters carefully explaining how each rule change impacts your unique retirement picture. No, they simply revise the policy, update the handbook somewhere, and assume you somehow already know. Because of that, countless Americans learn about these changes far too late. They discover them after they've already locked in the wrong claiming decision, after appeal. Deadlines expire and after the money is permanently gone. The entire purpose of this guide is to make sure you understand the exact information you need before any of those deadlines slip past you. To make this easy to follow, we're dividing everything into four separate birth year categories today: 1943 through 1954, 1955 through 1959, 1960 through 1965, and finally 1966 or later. Find your group mentally and let's begin. But before we break down those categories, we first need to define something called full retirement age, or FRA. This concept matters because it serves as the foundation for nearly every permanent financial consequence we're discussing today. Think of it like the concrete base underneath a building. Your full retirement age is the exact age where you officially qualify for 100% of your primary benefit amount. Claim earlier than that age and you permanently reduce your payment. Claim later and you permanently increase it. Every single piece of this system revolves around that one number, and as you'll soon see, that number changes depending completely on the year you were born. Okay, let's begin with Group 1. These are people born from 1943 through 1954. If you fall into this category, you're currently somewhere between 72 and 83 years old. Now, many people in this age range assume there's nothing left to review because they already retired years ago. But that belief could be costing you significant money. The first thing you absolutely need to verify is whether you are receiving the correct benefit right now. This is extremely important. Huge numbers of widows and widowers in this age bracket are currently collecting their own retirement benefit when they would actually receive substantially more by claiming under a deceased spouse's earnings record or vice versa. If you lost a husband or wife, you need to make sure you are collecting the highest benefit legally available. Survivor benefits can equal up to 100% of what the deceased spouse received. Really think about that. In many situations, the survivor benefit is far higher than what the surviving spouse earns through their own work history alone. But here's the major catch, and this is where people lose money. If your spouse passed away and you never directly contacted the SSA, asked them to compare both benefit options side by side, and specifically requested placement onto the higher amount, there's a serious possibility you've been losing money month after month for years. It does not happen automatically. You must actively advocate for yourself. So what should you do? The key here is immediate action. Contact the SSA directly at 1-008-722-1213. Once you speak with a representative, ask them specifically to review your benefit record alongside your late spouse's record and compare both totals directly. You need confirmation that you're receiving the highest amount legally available to you, but that's not the only concern for this group. The second enormous issue involves Medicare, specifically something known as the IRMA surcharge. IRMA stands for Income-Related Monthly Adjustment Amount. It's complicated sounding, but here's the important part. If your income temporarily jumped in prior years, maybe you sold real estate, completed a Roth conversion, or experienced another one-time financial event that temporarily inflated your income, Medicare may still be charging you higher premiums based on those outdated numbers. And these IRMA surcharges are serious. They can add anywhere from about $70 to nearly $500 extra on top of your standard Medicare Part B premium. So, if you are currently paying more than $185 monthly for Medicare Part B, stop and investigate why. If your income previously increased but later dropped again because of a qualifying life-changing event, you can file Form SSA-44 to appeal the surcharge. Please don't simply accept inflated monthly premiums if your current financial reality no longer supports them. Okay, now let's move into Group 2, individuals born between 1955 and 1959. If this includes you, you are currently between 67 and 71 years old, and honestly, this may be the most important group in 2026. Why? Because the rules change for every single birth year inside this range. Seriously, look how this breaks down. If you were born in 1955, your full retirement age is not exactly 66 and definitely not 67. It is 66 years and 2 months. Born in 1956 means 66 and 4 months. 1957 means 66 and 6 months. 1958 equals 66 and 8 months. And 1959 lands at 66 and 10 months. You absolutely need to know your precise FRA down to the exact month. This matters enormously because people inside this age bracket are actively making, or recently made, their final claiming decisions. And the difference between making the correct decision versus the wrong one is not temporary. It permanently shapes your retirement income. If you don't know your exact FRA, you literally cannot properly calculate the penalties for early claiming. To really understand the size of these penalties, let's examine the math carefully. Imagine you were born in 1957. Your full retirement age would be 66 years and 6 months. If you decided to claim at 62 because you didn't want to wait, your monthly benefit would receive a permanent reduction of about 25.8%. And that reduction lasts for the rest of your life. So let's say your full benefit amount was supposed to equal $2,000 monthly. Because you claimed early, you would receive $516 less every single month. Think about that amount. Groceries, utility bills, insurance payments. Over a 20-year retirement, losing $516 every month adds up to a massive $123,000 loss. $123,000 permanently gone. And here's the truly frightening part. The SSA doesn't sit you down beforehand and explain this lifetime cumulative loss carefully before you apply. They don't discourage you from filing. They simply process the paperwork exactly as submitted. Now let's flip this around and examine the incredible power of delaying benefits instead. If you belong to the 1955 through 1959 group, you are already beyond your full retirement age. And if you still haven't filed yet, you're actually in a very strong position. Every month you delay increases your permanent benefit by 2/3 of 1%. That compounds into approximately 8% annually between FRA and age 70. It functions almost like a guaranteed 8% annual increase backed by the government. Depending on your birth year, waiting can increase your benefit by 24% to 32% permanently. Returning to our earlier $2,000 example, delaying all the way until 70 could add roughly $640 extra every single month for life. That's enormous. There's also another complicated rule affecting this group. If you are still employed while collecting Social Security before reaching your exact FRA, the 2026 earnings test applies to you. In 2026, the earnings limit is $23,400. Earn even $1 beyond that threshold, and the SSA withholds $1 in benefits for every $2 earned above the limit. Now, don't panic. That money isn't destroyed forever. Once you finally reach full retirement age, those withheld benefits are credited back into your record. But if you don't understand this rule ahead of time and your monthly check suddenly vanishes without warning, it creates enormous stress for retirees. Okay, let's continue into Group 3, individuals born between 1960 and 1965. If this includes you, you're currently between 61 and 66 years old. And thankfully, the math becomes simpler here. Your full retirement age is exactly 67. The most critical thing you need to understand is what happens if you claim before reaching 67. If you file at the earliest legal age of 62, your benefit receives a permanent 30% reduction. 30%. Gone forever. Let's translate that into actual dollar amounts. Using our same $2,000 benefit example, a 30% reduction means losing $600 monthly for the rest of your life compared to waiting until 67. Over a standard 20-year retirement, that equals an astonishing $144,000 reduction. Completely erased. Think about what that amount represents. A second property, college money for grandchildren, financial peace during old age, and once again, the SSA will gladly process your application without sounding alarms about the lifetime impact. They simply ask whether you understand the reduction. You answer yes, and that smaller payment becomes permanent. But there's also a lesser-known strategy many people in this age group have never heard about. If you apply after reaching your full retirement age of 67, you can request up to 6 months of retroactive benefits. Essentially, the SSA can pay you as though you applied 6 months earlier than you actually did. With a $2,000 monthly benefit, that could create a lump sum payment worth as much as $12,000 alongside your first regular check. Of course, there's a trade-off because there's always a trade-off. Moving your official start date backward means sacrificing several months of delayed retirement credits, so your ongoing monthly payment becomes slightly smaller permanently. Still, this option exists. It can create an immediate cash infusion when needed, and very few people even realize they can request it. Also, for anyone in this group who remains several years away from claiming, one of the smartest things you can do immediately is verify your earnings history, which leads perfectly into our final category. Finally, let's discuss Group 4. Everyone born during 1966 or later. If this is your group, you're currently 60 or younger, meaning retirement claiming probably still feels far away. For you, full retirement age is fixed at 67. But what is not guaranteed is whether the government's earnings records about you are accurate. Your future benefit is calculated entirely using payroll information collected from your earliest working years onward. That information came directly from employers, and every single year created opportunities for mistakes. Incorrect digits entered, missing employment years, or self-employment income reported improperly. Think about people who worked throughout the 1980s and 1990s, back when payroll systems relied heavily on paper records, manual bookkeeping, and physical tax filing. There's a very real possibility that clerical errors quietly exist inside your file today. And here's why that matters so much. Every missing year can reduce your future monthly check by roughly $100. Really think about that. One small administrative mistake decades ago could quietly remove $100 every month throughout your retirement years. But thankfully, this is fixable. Here's exactly how to correct it. Step 1. Visit ssa.gov and create a My Social Security account if you haven't already done that. Step 2. Open your official Social Security statement. Step 3. Carefully compare the reported earnings for every year against your personal records. Search through old files, W-2s, paycheck stubs, or prior tax returns. Step 4. If you discover incorrect information or missing earnings, submit a formal correction request alongside supporting documentation. The SSA can process the correction and update your file. You truly need to do this now while your records still exist. Think about how difficult it already feels locating paperwork from 1995 today. Imagine attempting that search 20 years from now, right before retirement. Correct the problem while the evidence still exists and the fix remains relatively simple instead of discovering it too late. So before we finish, I want you to think carefully about one final question. Is your earnings history completely accurate? Or are you going to log in today? Verify everything carefully and make sure you receive every dollar you truly earned across your lifetime. Understanding these complicated rules connected to your birth year is not only about avoiding penalties, it's about taking control over your financial future and maximizing the benefits you rightfully deserve. Thank you so much for spending this time here today. Keep learning, keep asking important questions, and I'll see you again next time.